The revocable trust or the living trust is the document or the legal instrument to avoid probate, but it does not avoid any other liabilities. In other words, if you're sued, people can reach in that trust and take money out. If you're disabled and you have a spend down, then they'll reach in there and spend that down. So the living trust is an elegant and excellent way to avoid probate and privatize the estate, but it has no protection against liabilities, let me say. Okay? And with a revocable trust, you are the creator or the grantor of that trust. You're the trustee. You're the lifetime beneficiary. So you are in a very unique position of controlling everything, and yet it's a private distribution. You have all your assets in there. At your demise, your successor trustee, usually a spouse or a child, will just follow your wishes and distribute without even going to the probate court. Today, I have an estate we're administering, about $850,000 estate. We're not even going near the probate court because we had everything in there. A common mistake is that you create the trust, but you don't put the assets in. It's called funding the trust. So you have to make sure the bank accounts are titled in the name of the trust, the real estate is deeded in the name of the trust. And that takes a little bit of work, but usually within 60 days after the creation of the trust, everything is in order, and you can rest easier. Yes, sir.
How do you handle out-of-state real estate and a living trust?
You would deed the out-of-state real estate into your trust. So what I typically, we have Florida, I have clients with Florida properties, and so we would send documentation to prove the trust and who are the players of the trust to a lawyer down in that state that the client has chosen, and they would create a deed that the client would sign, putting it to the trust. So if you have real estate in different states, without using a trust, you will have a probate in each state. Okay, so unless you've done other things, but real estate is the domain of each state. Ohio has no jurisdiction over Michigan property or Florida property or anything out of the state of Ohio. So if you have property in 4 or 5 different states, you need to get that into a trust so that you don't have a probate in each state.
Okay, now if you have real estate that is jointly owned, husband and wife, do you have to create 2 trusts?
Depends on your estate. If your estate is subject to a federal estate tax liability, I would say yes, you need a trust for one and a trust for the other. But if it's underneath the amount for a federal estate tax, usually a joint trust is fine.
I understand you correctly. If a person has a revocable trust, you're saying it can be subject to after spend down if the person is in a
Yes. If you have assets in a revocable trust or a living trust, and your spouse is in a nursing home at $7,000 a month, that will be available for spend down. The Rev Trust does not protect any assets from spend down. Okay? And I apologize using that term. We're going to get to defining that term a little bit later. Okay. The second point on the trust slide is the irrevocable trust. And this is a trust we use for divestment. So if you want to avoid paying taxes on assets, you can divest out of your ownership into the ownership of an irrevocable trust, which has its own tax ID number. Then, after 1 year from a federal government point of view and 3 years from a state government point of view, that asset is not going to be taxed in your estate. Give you a really fun example. A lady came to me 4 or 5 years ago, and I gave her the same planning ideas, and she said, okay, let's put my home, which is attached to about 40 acres of land near development, but at that time it was in the country. And so we put that in an irrevocable trust. We had a contract. She could live there and enjoy it the rest of her life and so on. And she died 3.5 years later. that land was out of her estate. Well, by the time she died, it was valued at $1 million. No tax. And then, what about when that $1 million went to her children? Did they have to pay tax on that? Nope. Tax-free. So it was really a beautiful thing when I can experience the value that we put the property in at a lower value. It appreciated during those 3.5 years and went out to the beneficiaries at no tax. So it really is, it's a real thing. Don't think this is just funny stuff. All right. Irrevocable trust, asset protection is divestment. Third-party special needs trust. If you want to provide for a disabled individual beyond your lifetime, you need to create a special needs trust and put your money in it for the benefit of a named individual, disabled individual. By doing that, you don't have to have a Medicaid or a Medicare payback within that trust. Okay? Now, if on the first line there, the D4A and D4C trusts, I'm sorry, it says D4B, it should be D4C, excuse me. Those trusts must have a Medicare and Medicaid payback provision, because then we're using the money of the disabled individual. So if you give money to your disabled child at your death through your will, then it's their money, but they're already on Medicaid. Okay, what are they going to do? Well, they can create one of these trusts and put that money in there to protect it for their lifetime. But if they don't use it, it goes to the government. Whereas if you created the third-party special needs trust, put that money in that trust during your lifetime for the benefit of your disabled child, and that child can use that during their life, and when they die, then other beneficiaries that you have, perhaps other children, would receive whatever's left, not the government. So it's a good thing to know about. All right, let's go on to taxes. The first point there on income, I've already talked a lot about IRA distributions, but there is one point I want to mention I have except for PPA distributions. PPA stands for Pension Protection Act. That came into being January 1 of 2010. It was passed in 2007 by George Bush's administration. And what it says is, if you have deferred money, like a deferred annuity, and then you use that deferred income for disability, that will come out of that annuity tax-free. Okay? So what they're saying is, if you have accounts that are, you've put pre-tax dollars in, okay, or that have accumulated taxable dollars, but you haven't paid the tax on it yet, and you pull those out to pay for disability during your later years, there'll be no income tax on that accumulated taxable income. So it's a really excellent development, I think, in the area of planning. And for example, you can now make an investment using IRA money that if you ever use that money for disability, then it will come out tax-free. So it's really something to look into with respect to your plan. The estate tax, I've talked a lot about Ohio already. I'm going to just skip over that. I'm going to go to the federal estate tax. This year, the federal government said, no matter how much you own, we are not going to tax you. In 2010, there is zero tax. So you've probably read in the paper, George Steinbrenner, owner of the Yankees, he had like $9 billion. He died, no tax. Okay? Lucky kids. Right? Okay? Now, if Congress does nothing, if they don't do anything between now and December 31, 2010, on January 1, 2011, the tax goes from 0 to 55% on every dollar over $1 million. So, for example, let's say there's a single person with 1.3 million. Okay? A lot of families that were in their own business have easily 1.3, 1.5, 1.7, $2 million because they've accumulated from their being in their own business. Even if it's land, they own the land, farming or whatever. So all of a sudden, they're not worried about their state tax, okay? Because in the previous 5 years, the exemption amount was $3 million and $2 million and $3.5 million, and they knew they were way below that. And then it was zero. And so now, all of a sudden, it comes on 55% on everything over $1 million, and they have 1.3 million. They're going to write a check, a big check, but 55% of 300,000 is $160,000 to the federal government if they die January 2. Okay, so it really is important to look into. Okay, let's talk about gifting. There are two really wonderful provisions in the Internal Revenue Code. The annual gifting, you probably all are familiar and heard about. You can give $13,000 a year to anyone you wish, not just family members. But I caution you against writing a check for $13,000. Rather, write two checks, both of which are under $10,000. The reason is that the Homeland Security will pay you a visit if you're trying to write checks over $10,000. So, save yourself the agony of the Homeland Security. The other gifting provision in the Internal Revenue Code is the lifetime exemption, and that's $1 million. So every American citizen can give $1 million to whomever they wish during their lifetime. That is accumulative, but it's separate and distinct from the $13,000 a year. Okay? So if you give $1 million out of your estate to whomever, okay, that's tax-free. Okay, you can still give $13,000 a year to whomever you wish. So just to make the point, they're separate and distinct. Okay. Now, with the specter of that 55% tax rate coming in, those people with over $1 million are saying, well, now wait a minute. If I created an irrevocable divestment trust that we've just been talking about, and I gift a lot of money to that trust where I can get income from, because remember I said it's really the income you want to sustain your retirement, then you get that out of your estate, okay, then you save 20% because the gift tax is 35%. The estate tax will be 55%. So you can gift $1 million, but let's say you gifted $500,000 more. You would pay 35% on that $500,000 instead of 55% on the estate tax. So 20% of $500,000 is a lot of money.